Hi, everybody, and thank you for joining EIC's Summer Energy Outlook webinar today. What it won't include is a couple of things mainly. Number one, there aren't going to be any recommendations for particular procurement decisions that you should make, because the best procurement strategy for you needs to consider your own particular circumstances, and your objectives and your risk appetite, which obviously we can't know right now. So that isn't included. And also, and I think this is probably the most obvious thing, is, there aren't any guarantees for how the market or prices are going to develop, because that's just not possible. So I would say, just on those limitations, that it's not like it's a bad thing that we're imposing because we want to sit on the fence. It's just that it's a fact that, people need to have bespoke strategies for their own needs, and also no one knows the future. So if it was that simple, we wouldn't need to be here. So on to what the webinar will include. So as per the invitation, the main overarching aim of the webinar today is to provide information and insights to help you with your energy procurement choices. So the main focus will be on the energy commodity market, because, well, for two main reasons. They're the most significant part of your bill, and also the part that you can influence the most by the choices that you make. So we did have a webinar in September, just before, in the run-up to winter 2024. So we'll take a look back at that and what the key takeaways have been, and then we'll discuss the conditions and the market drivers, and explore what the potential opportunities and what the risks are, which is energy buyers are probably the things that you're most concerned about. And then there's a brief overview of the non-commodity changes, and then a bit of a session at the end for any questions that might have been asked. So first of all, who are Energy Intelligence Centre? I think most of the people in attendance today will be familiar with us already, so I'll keep this very brief. Business-to-business energy consultancy supporting organisations with lots of energy-related matters. Something you might not know is that 2025 marks the 50th year anniversary of EIC. So we've been around for a long time. Well, certainly for us, as far as energy consultancies goes, it's pretty much as good as it gets, 50 year. And I think the longevity of that is testament to the value of the services and solutions we provide. So these are who's going to be speaking today. There's myself, and then John and Ramnikh from our risk management team. If you've joined any of the other webinars, you've probably seen John and Ramnikh before, and me. So they'll be doing most of the talking about the markets. But before I hand over, I just wanted to just paint the picture of why we're here today. So it's fairly obvious. The energy markets are volatile, and they're sensitive. Prices can move very quickly, and that makes timing of the procurement decisions very important. So a few important things to remember are, you don't control the markets, we don't control the markets, no one in isolation controls the market. So the fact that you're exposed to it as energy buyers means that you need to keep a close eye on it, because you can't go back. When prices move, they've moved, and opportunities that may have been there aren't going to be there anymore. So you need to be engaged to make sure that you're protecting your organization and making decisions at the right time. So and I'd say that's also true for whatever your route to market is, whether you're fixed or flexible or whatever kind of contract you're in. It's the same market for everyone, essentially. So you are exposed to it, and the only way you can control that exposure is through the timing of your procurement decisions. So when we look at the price charts today, when Ramnikh and John go through them, the prices that you'll see on there, they're not price predictions or guesses for what the prices might be. They are real. It's real price data, from different trading platforms that we subscribe to. So it's what people are already buying and selling those future periods for. So if you are needing to buy energy for that period, and I'm sure that you all hope that your organizations will be around for a good while, you are going to have to buy it sooner or later. So what you're looking for as an energy buyer is the best opportunity to buy what you're going to have to buy. So if prices are rising, you don't want to be exposed, and if they're falling, then obviously you do. But the uncertainty makes that a challenge. So I think it's important that you understand that it is real price data that we're looking at, and these markets are liquid and active already for the next couple of years. And so I think it always makes sense to be engaged for that period as far as the markets are liquid, to make sure that you are, giving yourself the most opportunities to protect yourself and to get the best value. So to make effective choices, you need to understand what your objectives are. You need to be proactive and be informed. And also, I spoke to a few organizations that didn't like the idea of hedging. And I'm sure that most people here will already know that whether you're doing a fixed contract or whether you're doing a flexible contract, you are hedging. Few organizations don't actually want to do any hedging at all, and they can handle the swing of, the system price, and they just want a totally market reflective price. Most organizations don't want that, and they couldn't tolerate it. So most definitely will be hedging. Just a question of how and when you're going to do it. So hopefully through today's session, the information and insights that Ramnikh and John share, it'll help you decide, well, what kind of exposure are you comfortable with, and and what should you be doing. So with that, I'll hand over to John.
Thanks, Billy. Were you going to do the poll?
Yes, I am. Thank you, John. Oh yes. So before we start, just need to do a little poll if I can figure out how to do the button. So there's a couple of questions I just want to ask. The first one is just about what people's expectations are for the market. So how do you think over the next 12 months energy prices are going to change? So please go ahead and have a vote if you think they're going to go up, go down, stay the same, or you just don't know. And hopefully, when we give it another couple of minutes, well, another few seconds, people have cast their vote. And this might help John and Ramnikh to decide whether they maintain exposure or not, what people think is going to happen. Any last minute votes to be cast? Some people sitting on the fence, can't decide. Okay, well, we've got a lot to get through, so I'll close it there and see what the results are. So currently, if you can see that about half of participants thinks the prices are going to go up, quarter think it's going to go down, other part think it's going to be the same, and only 3% people don't know. So that's surprising, because I'd probably put myself in that 3%. So yeah, that's interesting. Thank you very much. And one other question, if I may. Is just about what people's exposure is. So I'm assuming if people are in flexible arrangements, they're already managing their exposure for whatever the contract they have in place is. So if you just take a look at the question and just say when your energy renewals are due, is it within 6 months, 6 to 12, 12 to 24, or 24 plus? Exciting watching the votes being cast. Any more votes? Less people have voted for this one than they did the last one. So some people don't know the renewals, perhaps. Okay, thank you. We'll leave that one there as well. So what that shows is that 17% have the renewals due in the next 6 months, 30% within the next 6 to 12 months. So that's nearly half of people have renewals due within the next 12 months. I'm assuming that's not the same half who think the market are going to go up, because if the market is going to go up, you probably don't want to maintain exposure to it. And then obviously some people have got longer dated contracts in place where they're not exposed, or at least they're managing the exposure to the market. Thank you very much for answering those questions. And thank you for the reminder, John. I'll hand over to you now. Thanks,
Billy. Yeah, so we're going to look back at winter 24. Like Billy said, we did have a webinar back end of, or the start of Q4, back end of Q3. So we'll go through a few stages. The first, we'll look at the fundamental outlook, the technical outlook, etc. Ramnikh will go through a lot more detail, but initially wanted to show you the first 3 slides. which will be next, Billy. So the first one is we're looking at the fundamental, what some of the risks were going into the winter. We had quite a few on the list here. Some of them are the ones highlighted will be the ones that actually did have more of an impact on price. Ramnikh will go through the fundamental stories. The last one had more of an impact on price over the last month and a half, the positioning in the market between hedgers and speculators. And that was tied into EU storage and still is. So we'll go into more detail about that. The next slide will show you is the more like the looking at price over the long term. We showed these two on the last webinar, and we were at the far right-hand side. It's just updated with the last, what are we talking, 5 months price data. So we're still, okay, for those who have seen this for the first time, this is looking back at prices since 2004 to present. This is looking at forward pricing every whatever forward seasons are available at a given time. So presently we're looking at, summer 25 out to winter 26 on the gas. It's interesting how price was stuck within a range where we're saying the circa 30 pence per therm on the lower end, scaling up to say 100 on the upper end. During the Russian crisis, the gas crisis, you can see how prices really shot out of that. And this is on a log scale. So for every move up, we're moving up 100%. We're doubling up in price. And you can see the extremes that we got to, and since then come back down. Presently, the market is hovering at what we would call is, I guess, the upper range prior to 2021. Now, the question, I guess, going forward is, do we stay above this range in the next year, 2 years, 3 years, who knows? Or do we start to go back into what was the normal range? So there will be a short-term picture and I guess and a long-term outlook for if and when those things may happen. And the next slide will show the power market is pretty much kind of a similar behavior. Okay, so with gas shooting up during the crisis, the power market followed through. And again, we're at the top of the old range. And again, do we head back lower inside that range over time, or do we hover up here and is this the new bottom for us? And these are bigger questions yet to be answered by the market in the coming, I guess, I won't say necessarily the months, but in the coming years. Okay, with that, we'll move on to Ramnikh, who will go through a lot of the fundamental pictures over the winter.
Thanks, John. So as you guys can see from this graph here, this is basically the winter 24 gas contract against how it outturned on the day ahead. So 1 year prior to delivery, the average winter 24 gas price was 101 pence per therm. Out on delivery, so on the day ahead, it's outturned to be around 10% higher. So it's outturned to be at 110 pence per therm. And the key driver here has been higher gas demand for both household consumption and power generation. Also, day-ahead gas markets continue to be impacted by global market events such as, or global market fundamentals such as higher demand or higher gas demand in Asia, the number of LNG cargoes arriving in various parts of the world, as well as European storage levels. Moving on to the next slide, please. So this is a similar chart to the power. Winter 24 power prices have averaged around £91 throughout the winter 24 period for the last year, and on the day ahead it's been quite volatile, and it's averaged about 98 quid, which is about 7% higher. The key driver here has been higher gas demand, as well as periods of low wind generation. On days where wind was low, prices were at roughly £50 per megawatt hour. Sorry, when wind was high, prices were at around £50 per megawatt hour. But on days where there was a lack of wind, we really saw the system being extremely tight, and we saw prices as high as £100 or even £200 per megawatt hour. The key point here is, look, on the day ahead this winter, we've seen prices turn out higher than where they were prior to delivery, and this is in contrast to prices And this is the contrast to prices over the last 2 winters. So being on the day ahead is not always the most optimal strategy. As Billy mentioned earlier, sometimes hedging can be quite beneficial to protect you from future price spikes. So moving on to the next slide, which is the temperature slide. As you can see from this graph, temperatures for Jan, February, and March this year, which is the green bar, has been below seasonal normal. It's been colder this year or this winter compared to the previous 2 winters, and because of the fact that it's been cold, there's been higher demand for household consumption. Moving on to the next slide. So LDZ demand is basically gas demand for household consumption and consists for about 50% of the demand during the winter period. For Jan, Feb, and March, it's been extremely strong because of colder temperatures. Moving on to the next slide, please. UK wind generation, which has caused higher gas demand for power generation this year, has been largely below seasonal normal. The orange bars, as you can see, for March, February, and Jan, have been significantly lower than the normal average, and that's led to higher gas demand for power generation, as shown by the next slide. Gas demand for power generation normally consists of 25 to 30% of winter gas demand. And this year it's been extremely strong because of lower wind and generally lower renewable generation. And because the market has been using a lot more gas in its power generation mix, prices have been higher on the power. Normally when wind is high, solar is high, and the cheaper fuels to use in the input mix, power prices are normally a little bit more lower or subdued. But when gas is used as a fuel, prices generally turn to be a lot higher. So moving on to the next slide, which is the supply. But just to quickly give you a quick summary on the demand side. Demand has been strong this year or this winter compared to the previous 2 winters, and that explains some of the volatility and some of the firm pricing on the day ahead this winter. In terms of supply, we've not had any real hiccups this year in terms of the supply. Norwegian supply, LNG supply, and domestic production has been largely strong, and hence no real price spikes based on a shortage. But in terms of the LNG sender, you can see that the March and February bars have been significantly higher because LNG has been playing a significant role in meeting domestic demand. So far this year, we've had 108 cargoes arrive at UK terminals, mainly because of the fact that the UK spot price is at a premium to both the TTF, which is the European gas market, and the JKM, which is the Asian gas market, and it's made the UK an attractive destination for cargoes. So LNG send out has been strong compared to previous years, particularly for February and March, which has basically meant that we've not had no real supply issues. Moving on to the next slide, please. UK storage sites have been largely in withdrawal mode. As I mentioned earlier, January and February were quite cold, and hence the steep decline in the green line. UK storage capacity still remains small compared to its European counterparts, but as it stands now, we're still in withdrawal mode, and the expectation is that storage sites will be in withdrawal mode going into April as well, due to the fact that April is forecast to be below seasonal normal for the first 2 weeks. As it stands right now, UK storage is important to pricing, but it's not as important as European storage, which John will elaborate on later. And the reason for that is the UK only holds about 8 days worth of winter gas supply in its store. So compared to Europe, which probably has about 90 days worth of winter gas supply. So the capacity in the UK is small, which basically means it's not that much of an impact driver on price. However, the European storage market still moves the UK market prices. So moving on to the next slide, please. So other factors which have impacted the markets has basically been Russian and Ukrainian attacks on infrastructure. So this has been happening throughout 2024 and is expected to continue, adding to the volatility in the near term. Government intervention, European storage targets have also been a price factor. so far. There's a mandate by the European government to have storage at 90% by the 1st of Nov. That's still in place right now. There is some flexibility with regards to that target. However, that's basically created a premium for summer 25 over winter 25 for most part of this year, which I'm going to explain a little bit more in a later slide. But yeah, the government intervening has basically led to higher gas prices at some point in time. When it's been a free market, prices have been there or thereabouts. But as soon as the government has intervened, market participants have started to take a view, such as the hedge funds, and taking positions accordingly. So in terms of the third factor is Donald Trump's peace talks with Russia. So last week or the week before, there was a meeting between Russia and the US, which basically led to a 30-day ceasefire on energy infrastructure. However, 30 minutes after the meeting, there were still attacks on energy infrastructure, which basically meant that this factor is short-lived. If there are peace talks or if there is an agreement, eventually, this basically just means that there's the possibility of Russian gas supply coming into Europe still exists. And the last factor is the market remains extremely sensitive to supply shocks. Any Norwegian outage or any LNG terminal outage in the US had an impact on markets as well, on oil prices as well. Although the impact wasn't as significant as it was last year, the market still is very tight, and any impact on any supply that impacts the global supply network can have a direct impact on UK gas prices. It was basically last year where we saw the Australian LNG worker strike, which led prices to rise by 15% on any given day. So something like that we can't rule out going forward. Although the impact hasn't been as severe this year, it's still a factor which is causing prices or to rise or fall or impacting market sentiment. So moving on to the next slide, please. So now I'm going to talk a little bit about the summer 25, winter 25 gas prices and the kind of ranges they've traded in, and the kind of things that have impacted the price over the last year. As you can see from the chart here, prices for summer 25 and winter 25 have largely been between a 90 and 110 pence per therm. It's been volatile, however, they have been trading in a certain range. As you can see from the green line, summer 25 started March 24 at 70p, and it went as high as 130p, which is nearly a double in pricing. But right now it just trades above 100 pence per therm. A key theme last year has been the Russian and Ukrainian attacks on energy infrastructure, as well as EU storage refill concerns, which were quite severe during the first quarter of 2025. As you can see from the last box here, the summer 25 line was at a premium to the winter 25 line, which basically is very abnormal. The last time this happened was during the Russian invasion of Ukraine. And the reason why this sort of thing happened was because of the fact that the government had intervened, or the European government had intervened and stated mandated goals for European storage targets for the summer period, as well as the 1st of November. So due to rigid government storage targets, the summer 25 contract basically traded at a premium to winter 25. More recently, what we've seen is a summer 25 contract turn to a discount, and the reason for that is there's been a document released by the European Commission which states that the top storage targets are likely to soften. So overall, in terms of the fundamentals, they've largely been quite stable, to be honest, over the last year. The only thing moving the market has been geopolitical uncertainty, as well as storage regulations in Europe. So, and those are expected to be quite critical price factors as well going forward. Moving on to the next slide, please. So as I mentioned earlier, the summer 25, winter 25 gas spread has turned positive over the last 3 or 4 months, having been negative throughout most of the year. So what does that actually mean? So that basically impacts storage injections. So normally what happens in the UK and Europe is during the summer period, storage sites normally inject gas into store because gas in the summer is usually cheaper, and then they normally withdraw that gas during the winter period when gas is more expensive. But in order for that to happen, the price spreads have to be, the difference between the summer 25 and the winter 25 price has to be financially viable. In this case right now, injections are not viable because the summer is at a premium, so which is likely to delay storage injections, which could add to some of the more price volatility going into the summer period. So right now, summer 25 over the last 2 weeks or so has basically come to a discount. However, I'm not sure if it's at the level right now where storage sites still see it as a injection level. Just something quickly to note here as well. So the summer 25 winter 25 spread was largely negative throughout the year, but positive over the last 4 months. But in the European market, it still remains at positive. So the European storage players are not convinced that at these levels that storages are going to be viable. So that's going to be quite an interesting thing to look out for going into the summer period. Moving on to the next slide, please. So in terms of the electricity, this is both the summer 25 and winter 25 power price. They've been fairly range bound as well, between 70 and 90 pounds per megawatt hour. We saw a similar spike on the gas during February. Just something to note here is that the summer 25 gas contract did not really go at a premium to the winter 25 contract. The winter 25 has always been at a premium, and we had a few days where it was flat or marginally negative spread. However, the same dynamics that impacted the gas has not really been at play on the power side of things. So yeah, just in a nutshell, summer 25 and 25 prices have largely been range bound but volatile, and the market still continues to seek direction. In terms of the fundamentals, they've been largely stable. The key driver of prices have been European storage regulations and some of the geopolitical uncertainty with regards to Russia, Ukraine, which John will elaborate on a little bit further in the webinar.
Thanks, Ramnikh. So yeah, we're going to try and look forward to what's going to impact the market as far as sentiment is concerned, how buyers and sellers operate in the wholesale market, and how that pushes energy prices up or down or unchanged. It has to be said, a lot of what Ramnikh has said kind of spills over going into the forward outlook, because a lot of what's been highlighted is still ongoing and will likely have an impact on prices. So we've just highlighted just a few of the things that could continue to have an influence. And again, this is subject to change because it's an ever-changing landscape. Whatever comes into market as an input that makes people decide whether contracts are overvalued or undervalued, that's going to change over time. So for the time being, this is what we consider to be a continuation from what's gone on through the winter going into this summer. Some of those fundamental factors will continue. So we'll try and go through these one by one on the following slides. So we'll start with the European and Asian gas prices. Now, there's a relationship between Europe and Asia as far as competing for LNG is concerned. So the relationship between the two markets, when one has a premium, US exporters, for example, will say, well, I'll take it to the market that's willing to pay more for my gas. Obviously, when we consider costs of travel, Europe is closer to the US, at least where the export plants mostly are, compared to Asia. So as far as journey is concerned, it's shorter to come to Europe. It takes a longer time to get to Asia. But if the price difference between Asia and Europe is such that it covers also the cost of transport and it's profitable to take to Asia, then they will do so. Now, the profitability for the US market is huge at this point in time. Each cargo, one cargo, LNG cargo, on average can be 30 million pounds worth of profitability as far as that margin is concerned. US gas prices are extremely low, and they want to export as much LNG as they can because it's extremely profitable for them to do so. At the height of the crisis, European, UK prices had a massive premium compared to Asia. That was Europe screaming that we want your LNG above everybody else and outbid everybody else in order to do that. So these lines will, over time, as we go through the next couple of months, etc., it's going to keep moving up and down. One market will have a premium over the other, and then switch roles. So it's never a static relationship between the two. So whoever needs it more will obviously want to pay or put in a premium in order to attract the supply to come to that particular market. The next slide will show the imports. Again, this is more of a larger summary to what Ramnikh had showed earlier. We can see the Q4 back in Q2, sorry, in 2024, back in Q2, we can see how the number of cargoes and the volume that came in basically shrunk. That was a consequence of our prices really falling in February and into March of last year. There was some recovery into Q4, but we can see the bump up in Q1. Going forward, it's a question of, for UK and Europe combined, does that LNG import stay high, on the higher end? And more so because obviously there is no Russian pipeline supply this time around. So LNG as a supply source is extremely important to UK and Europe, as is Norwegian supply. But specifically here for LNG imports, they'll have to stay high and stable going into Q2. The UK acts as a transit, the go-between for Europe and LNG that comes, because Europe has a finite amount of LNG terminals. UK has some well-established terminals, and we have connectivity to Europe. So the LNG cargoes arrive into the UK in the summer, and a lot of that gas makes its way through the Zeebrugge pipeline and BBL pipeline into Europe to replenish the storage there. So looking ahead, this has to stay strong and stable. Any issues on LNG imports for UK and Europe will cause a wobble and have an impact on prices going forward. Okay, so it's a very important input for the market, this. The next slide will show how the US LNG exports have been rising over the last few years. Quick story is that the US was meant to be an importer of LNG. The Qataris built their LNG export facilities to send LNG to the US. And then the US found fracking. And now it's the #1 exporter of LNG. So it's quite a turnaround in events. This is expected to continue to rise on the right-hand side of this chart as we go into 2026 and into the coming years. So this as a source of gas for the global market is a growing source of supply. As you can see, the last point in February, US exported 8.35 million tons of LNG, and 82% of that went to Europe. So it's showing quite a pivot. This wasn't the case pre-crisis. So Europe's trying to plug a hole with the lack of Russian pipeline supply, and to fill that gap, Europe's pivoted to the US as a supplier. And as a supplier, that gas is going to continue to grow. So looking ahead, we can see, which I'll show later on in some slides, we can see 26, 27 prices are at a discount because there's an expectation of more supply to come to market as far as gas is concerned. What is unknown is the demand going to be as strong on the rise as the supply is rising? If not, there'll be an oversupply situation, in which case maybe prices will stay in a low price environment with low volatility. But if demand is matching supply, then things get a little bit tighter. Demand is a difficult one to always to try to gauge. But what is known is that the supply is coming. Okay, on to the next slide, we'll see how this is basically the main driver at the minute of sentiment. This shows European gas storage as it stands. Circa, I think we're below 34% full as an aggregate volume. The blue, or purple and red, sorry, I'm colorblind. The two top lines is basically where we finished the last 2 winters. The yellow is showing where we are finishing this winter. So there's a disparity between the two. It's been a lot colder, as Ramnikh showed in the previous slides, and we've had to use a lot more gas. Say we, the EU has had to use a lot more gas, both LNG imports and to take out of storage in order to satisfy demand. What the market is unsure of going forward is, how do we replenish? Do we end up like we did in 21 with the green line at the end? Or do we get enough gas in there? And it's the LNG question, plugging the lack of Russian supply, that is unknown. Will we get all of the LNG needed to satisfy the storage demand? this is what's not clear for the market, and I think this is what's going to cause a little bit of uncertainty going forward, and will likely drive sentiment either bullish or bearish. If the storage situation, if storage is replenishing at a decent rate, say into Q2, then participants are going to project they're going to Q3 and the start of Q4 that the likelihood of being full is more probable. If we start slow, then there's risks that we don't have enough gas in store by the start of the winter, and each one of those then will pull prices up or down. The EU policymakers are influencing what's going on here, and actually we'll talk about that one in the next couple of slides. But yeah, so this is an important one. The LNG is important. Storage, how this refills for the winter, in readiness for winter, will be important going through the summer. It's the first time that Europe's been this empty without Russian pipeline supply availability. So it's a new paradigm for the market. Storage sites have always filled up. It's just a question mark, a big question mark at the minute that hangs over the market. Okay, next slide, we'll see the storage regulation that the EU. So the EU Commission has basically said that they have to be, on aggregate, again, European storage sites need to be 90% full by November. There are interim targets made in July and in September. These were enforceable. So they passed a law that in order to have a security of supply. So it's understandable from a policy perspective that they want that gas in there. But given how much has been drawn down this time round relative to the last two, end of last two winters, the ask is a lot higher now. The need is a lot higher. And yet you've got these predetermined levels that these storage players have to get at. So there's a speculative section of the market has taken it that there will be a determined buyer of a summer contract to put gas in store. So therefore, these investment funds took a massive position on the prospect that these storage players will take that gas. And if regional governments, like say, for example, the German government, step in and say they will subsidize this, it means that there's even deeper pockets willing to pay any price for this summer contract to put this gas in store. Hence the disparity we're seeing with the summer and the winter pricing on the gas. Now, we're still waiting for further clarity as to if they're going to stick to these mandates at these levels, etc. There was talk of flexibility. There's talk of changing it from November to December, wait and see approach, instead of having the interim targets as they are, tweak them by 5%. There's just no clarity as to how the policymakers want to influence this, getting the security of this gas in store. So this is yet to be determined, and it's likely to bring about price volatility in the shorter term, as maybe new headlines come out about how they want to proceed or whatnot. The fact that they also want to continue with this into 2027, so we're talking into next summer winter cycle as well, that this kind of hangs over the market. So it's an ever-changing landscape with this, and it's likely to have an impact on sentiment moving forward. So on the next slide, we'll see the weather. The forecasters that we followed, WSI, they have an indication that April it will be colder, and it could turn out colder if certain weather patterns play out. Again, this is subject to change with the weather. It's very difficult, obviously, to forecast for a whole month. Looking into summer, the way the weather plays its part is how much gas demand is taken off the grid to allows an excess as such on the grid that can go into storage. So for the UK's perspective, high renewable generation through the summer as temperatures are dropping. So you've got low heating demand disappearing, but you've also got renewable generation increasing that has a a double effect on demand. And if the supply is not turning down as fast as the demand is dropping, you have an excess, liquidity as such. You've got a lot more gas available. That can go into storage. The negative, though, is that if we have low renewable, and therefore you have a higher gas need for generating power, the demand in itself stays slightly elevated. And therefore it takes away any excess as such that could go into storage. For Europe, more importantly, they have cooling demand, air conditioning. So if it's hot and low wind, not only is there less renewable generation and therefore more need for gas, but you're also taking gas for power needs higher because of the air conditioning load, etc. So that's how it works for the summer, which is different from the winter. So in a nutshell, we need high wind, high renewable for the UK that allows for excess that can go into storage and help replenish the storage. That would be the positive. Next slide, we'll see how the geopolitical uncertainty. We weren't too sure whether we should have this slide on because this is an ever-changing landscape. I'm not too sure at this point where, as far as Russia-Ukraine's concerned, even if there has a ceasefire, how that impacts the gas market directly. I think where the positive maybe out of this would be that at the minute, Europe is taking a lot of Russian LNG. The fact that sanctions as a tool will probably cease if there's a ceasefire deal, kind of takes the risk away that Russian LNG then would be the next target. And I mean the Russian LNG that's currently coming to Europe. There are some other, there is a particular Russian LNG project that was meant to supply Asian, I think it's Japanese market. Because of sanctions, that's been stopped. So there's having to be a rebalancing on where did the Japanese buy who were expecting that LNG, where did they go? It kind of reduces the pool of LNG that was available. If sanctions are lifted, for example, and that project comes back online, it allows for more LNG to come available to the global market, which kind of loosens supply, which is a positive. That's probably where we think things might lie. In the west of Ukraine, there is some storage facilities that some European gas companies will use for storage. I guess if you take the risk away of them being harmed, such maybe that allows for the continuity of their facilities to be used. Otherwise, there's risk on, that there could be damage to those, so they don't necessarily utilize those facilities. Up until 20th of March, the idea that Russian gas could come back, the first point I think most people were expecting was that the transit gas that was going through Ukraine up until I think the 1st of January, that would be the first point that maybe we could see some gas molecules flowing. But on the other end of the ceasefire, there was an explosion and fire at that 𝐒𝐩𝐤𝐬 facility. So the idea that gas could flow through that particular route and return of gas through that particular route, it seems null and void at this point. So yeah, it's an ever-changing landscape. We're not too sure yet what's going to happen. And it's that uncertainty that can play on sentiment in the market as to whether things are overvalued or undervalued, or whether risk needs to be put back on into the market. So for the next slide, we'll see so Russian pipeline. Again, this is just to reiterate what I just mentioned. I think the EU Commission reported that, was it 45% of EU's gas imports came from Russia in 2021. But up until 2024, that's now only 18%, but that's including LNG. So there's a massive amount of gas that's missing from the market. If this was to ever come back, I mean, hypothetically, even say in the next 4 years, if some of this gas comes back as US LNG is rising, we'd have a confluence of supply really building up. And if that meets demand that's not necessarily increasing at the same rate, that would allow for a situation for prices to drop, to stay in a low price environment. But this is a long way away. But this is gas that's missing. Could it be gas that comes back at some point in the future? And if the geopolitical world improves, is the prospect of this gas ever coming back? You know, does that likelihood start to look more positive, more probable? I think for us, we assume this is going to be quite a way away at this point in time, because there's a lot of legal and contractual frameworks that will have to be done up quite quickly in order for that to happen. So moving on quickly, we've got, so yeah, as a summary, bullish and bearish. If we go back to the previous slide, please. Yeah, so bullish, again, it's what's going to impact this. It's a storage that's the big story going into the summer. If that replenishes really well, it's going to have likely a bearish, or at least limiting prices to the upside. It's going to have a drag down effect on pricing. If there's any supply shocks, like Ramnikh mentioned, if it's LNG or if it's Norwegian supply and it slows down the input of gas into store, it will have a bullish impact on price. That'll be the main one. I think, as well as depends on this government regulation as far as the storage is concerned. That's an ever-evolving picture. On the bearish side, it's if that gas gets in there quickly, it's going to temper the winter risks as such, because we're saying that there's gas going to be made available. So if the refill happens quite well, that's going to be fine. As far as the storage mandate is concerned, if the governments take a subsidizing route, the gas will get in store. It'll come at a cost, but the gas will get there. So it should temper the winter prices to some degree, because the gas will get in there. It'll just happen at a cost to the taxpayer at this point. I think that's it for now. I think things are not very clear at this point, but if we could do a quick poll with just that quick summary, Billy, just to see what everybody thinks about market prices. Again, it's similar to, it's just the same poll that we did earlier.
Yeah, thank you, John. Hopefully that's on the screen now. It was just wondered, after we've listened to what John and Ramnikh have been saying, what people think now. Do we think the prices are going to go up, go down, stay the same, or don't know? So it was just really to see if people's views had changed since the webinar began. So I'll just leave that a couple of seconds just for the last few people just to cast the votes as well. Give another 5 seconds. Anyone's making up their minds. Okay, we'll end it there. It's a bit different to what it was at the beginning. So at the beginning, slightly more people thought it was going to go up. I think it was higher 40%. So fewer people think it's going to go up. It was about a quarter who thought it was going to go down. So that's about the same. But the don't knows was at 3%, and that's up to 17%. So more people don't know, or have less confidence, I suppose, on whether the prices are going to go up or down, which I think is as it should be, to be honest, because the future is uncertain. So that kind of makes sense. So hopefully that's all been useful.
Yeah, so we'll go really quick onto the go forward onto the next. So what we just wanted to show now was more of a technical picture, just really quick. This is a rolling front month, so all of the bias of the market is on the front month contract. That's where a lot of the hedge funds are also participating. And since the crisis, until June 2023, we dropped down. You can see how prices rose up until October 2023, and then we had that strong decline in February 24. All the LNG switched off. We didn't get much into Q2, and we've seen prices then recover up until the peak just last month. And then since that dropped down. So I believe you just click through. So we're stuck in this range we're stuck in this range. And at the minute, we're in the middle of it. For the reasons I mentioned, bullish or bearish, things can go either way. If things are bearish, fundamentals play out and it's a stronger influence on the way people view value, it's likely that prices may head down to the lower end of that range. And so for the forward contracts, we probably get back to where we were back in February. And thinking about the longer term picture that we showed way back at the beginning, does that take us back into the long-term range again? But if things don't pan out so well this summer, the storage, for example, doesn't fill out, Norway has a big problem, just any kind of influence that sees a shortage of supply, that will likely take us back to the top. And we may break out to the upside again. Now, for those, that's where risk of, if you have any contracts, that's where to really cut off your risk to a large degree, because if we go above the peaks that we've seen above there, that holds a prospect that we get into the 200 levels again. Okay. Yeah, that's it for this slide. So it's uncertain. So for people not to quite know, it's what the market is showing. We're sideways in a range. It can go either way. There is no clear trend in the market. Yes, we have upside in some timeframes and downside in others, but bigger picture, we're in a sideways range and we can go either way. So the timing perspective is difficult. And lastly, the last two slides for me were just to show the forward contracts. This is looking at the seasonal prices, but this is to show, if you take away market timing out of it to know, oh, is this the best time? Maybe it's what's the market providing from a price perspective that is more of an interest. So if you had signed a contract on a higher end and prices are probably, if you don't take the timing of it, it's just more the availability of price at this point could be a lot lower than what you've previously been paying. So from a commercial perspective, a year-on-year decrease in cost is probably a better grab for you in a sense. And this is just showing how the shape of the curve is, that the summer 25, winter 25s, if we look at the summer 26, winter 26, there is a decent percentage decline in price and therefore cost, assuming same volumes are used. And if you look at the 26s versus the 27s, again, the 27s are even further lower. So if we take timing again out of the equation and just look at what's available now, it's worth thinking about how longer dated prices at the minute are offering a discount. And again, this is subject to everybody where they are contractually at the minute and timing as far as contracts are concerned. But from a year-on-year savings, the market's kind of providing that for you, that opportunity at this point. Thanks. That's all from me, Billy.
Thank you, John. So yeah, I think just to kind of summarize some of the challenges that you face. There's lots of factors that influence the prices, and no one knows for certain how prices are going to develop. So the problem that has is that the price movements are significant. So as energy buyers, getting it right or wrong can have massive implications on your organization. So what do you do about it? Just like we said at the beginning, there's not one answer that's right for everybody in all circumstances. You need to understand what your own objectives and requirements and risk appetite and whatnot is. But there are some fundamental principles that we would always recommend that people exercise. So you should have a clear strategy that's aligned with your objectives and what your requirements are. Should then be engaged and be well informed, be proactive and adaptable, just to make sure that you don't get caught out. I mean, there's lots of things you want to do when you're doing, when you're looking after the energy contracts, and the negotiation, and those kind of things that you'll do when you're, doing the competitive process to select a supplier, they're all important. But when you look at how significant the price moves can be, like a doubling in price over a year, I mean, obviously that's just for the commodity portion of your costs. Those movements are significant, and if you look back to 2022, which hopefully we won't get back to again, those kind of events, which you are exposed to as energy buyers, if you get it wrong, if you're on the wrong end of that and you have to then buy the energy at a really high price, then it can be really difficult, and I know a lot of, organizations, didn't survive back in 2022. There was quite a lot that went under for, various reasons, but energy costs certainly wouldn't have helped. So, I mean, people on the webinar today might have their own experiences of how, the extreme prices of 2022 affected them. But, if anything, it should serve as maybe a lesson to be learned that, you are exposed to the market and they are volatile. And what you need to do is just to make sure that, you're managing that exposure. So by being proactive and, particularly if you're doing fixed contracts, you're probably going to be fairly pragmatic as well. You can never chase the bottom of the market. And, aside from the market challenges, I'd probably also, remind, well, people already know, but organizational challenges have to be considered as well, because, people don't just sit around monitoring the market all the time. A lot of people will have other priorities and other things that they need to do as well. And a lot of organizations have, approval processes which take a while. You've got longer sign-up processes and committees and whatnot. So those things can slow it down. So when timing is critical, in a volatile market, I think having a strategy in place is important. Sorry, I'm just distracted by some questions. Very quickly, just before we look, oh, we've only got 2 minutes left. I just wanted to mention a couple of the non-commodity things you need to be aware of. So on your bill from next month, some people might see the Energy Support Levy being itemized on bills. So so for organizations that aren't EII, you're basically going to be subsidizing the relief that's being provided to EII organizations as part of the British industry supercharger. So they're getting some additional relief, some costs, and obviously someone has to foot the bill. So the expectation is of about 0.08 to 0.1 pence per kilowatt hour. So hopefully not too much for people to cope with, but that's coming. And some of the costs might be backdated to April 24, so there could be a reconciliation on some people's invoices. So look out for that. There's also the market-wide half-hourly settlement, which is happening. The timeline is being pushed back a little bit to later this year, but there are changes coming for organizations. If you've got an estate with a lot of non-half-hourly, then you'll probably be affected the most. You need to probably look at what kind of communication technologies are being used, because RTS, 2G and 3 communications are going to go. There'll be some changes to the agent rules, so like your data collectors and your MOPs aren't going to be those anymore. There's going to be some different names for the different people looking after the different parts of the system. And the way that some of the costs are settled, and the minimum requirements mean that there'll be more reads required. So there's probably going to be some additional costs for people with larger non-half-hourly estates. There's also a nuclear RAB charge on the way. REMA, we've used it now, so I won't go into it, but there are a couple of other things that you need to be aware of. So if anyone has any questions about that, please just give us to contact us separate to this webinar, and we'll be happy to talk about it. Anyone who's asked a question, I'm sorry that we haven't got back to you on it within the session, but we'll take it offline and we'll come back to you. If anyone's thought of any questions now and haven't had time to post them, then feel free to let us know. With that, I think we'll end the session. So thank you very much for joining today. I hope you all found it useful, and I hope you'll be able to join future sessions that we will hold.